Gold has been one of the most talked about assets in the world over the last few years. Every time it rallies, investors start talking about new all-time highs. Every time it pulls back, headlines begin predicting the end of the bull market. Recently, a growing number of analysts have suggested that gold could eventually reach $5,000 per ounce. But before that happens, there is one important question investors need to ask. Could gold experience a major crash before making that historic move? Today we're going to dive into the charts, the macroeconomic landscape, investor psychology, and historical patterns to uncover what may really happen next. First, let's understand why so many people are bullish on gold. Gold has traditionally been viewed as a safe haven asset. When investors lose confidence in governments, currencies, or financial markets, they often move money into gold. Over the past several years, we've seen rising government debt, persistent inflation concerns, geopolitical tensions, and increasing uncertainty surrounding global economic growth. These factors have created a strong foundation for long-term gold demand. Central banks around the world have also been accumulating gold at a record pace, which further strengthens the bullish case. However, markets rarely move in a straight line. One of the biggest mistakes investors make is assuming that because an asset has a strong long-term outlook, it cannot experience sharp corrections along the way. History tells us the exact opposite. Even during powerful bull markets, gold has experienced multiple pullbacks of 10%, 15%, 20%, and sometimes even more. These corrections often shake out weak hands before the next major leg higher begins. That's why investors need to separate short-term price action from the long-term trend. When we examine previous gold bull markets, a fascinating pattern emerges. Before many major breakouts, gold often undergoes a significant correction that convinces investors the rally is over. We saw this behavior in the early 2000s bull market. We saw it again during periods leading up to major advances in the 2008 to 2011 cycle. The market tends to create maximum emotional pain before making its biggest moves. In other words, the possibility of a gold crash before $5,000 is not only possible, it may actually be part of the journey. Now let's talk about the current technical picture. From a chart perspective, gold has experienced a tremendous run over recent years. Whenever an asset rises significantly above its long-term trend lines, the probability of a correction increases. This doesn't necessarily mean the bull market is ending. It simply means prices may need time to reset, consolidate, and allow moving averages to catch up. Markets function through cycles of expansion and contraction. Extended rallies are often followed by periods of digestion. One factor investors should watch closely is the strength of the US dollar. Historically, gold and the dollar often have an inverse relationship. When the dollar strengthens significantly, gold can come under pressure. If economic conditions lead to a temporary surge in dollar demand, gold could experience a sizable correction, even while maintaining a bullish long-term outlook. This is one reason why some analysts believe gold may face a difficult period before ultimately moving much higher. Interest rates are another critical piece of the puzzle. Gold does not generate income like bonds or dividend-paying stocks. When real interest rates rise, gold can become less attractive relative to other investments. If central banks maintain higher rates for longer than expected, gold could encounter headwinds. On the other hand, if economic weakness forces policymakers to cut rates aggressively, gold could benefit substantially. This tug of war between inflation, growth, and monetary policy will likely determine gold's path over the coming years. Another important consideration is investor sentiment. Whenever an asset becomes universally loved, caution is often warranted. We've seen periods where gold dominated financial media headlines, social media discussions, and investment newsletters. While strong enthusiasm can support prices temporarily, excessively bullish sentiment sometimes signals that too many buyers have already entered the market. When expectations become unrealistic, even minor disappointments can trigger significant sell-offs. Let's imagine a scenario where gold experiences a correction of 20% or even 30%. For many investors, that would feel like a disaster. Financial news outlets would likely publish dramatic headlines declaring the end of the gold bull market. Social media would be filled with panic. Yet from a historical perspective, such a decline could simply represent a healthy correction within a much larger uptrend. This is why context matters. A short-term crash does not automatically invalidate a long-term bullish thesis. Now, let's address the $5,000 target itself. Can gold actually reach that level? The answer depends on several variables. If inflation remains elevated over the next decade, if government debt continues expanding, if central banks keep accumulating gold, and if confidence in fiat currencies weakens, then significantly higher gold prices become increasingly plausible. In nominal terms, a move to $5,000 would represent a substantial increase, but it would not be unprecedented when viewed against historical periods of monetary expansion and currency debasement. Geopolitical uncertainty could also play a major role. Throughout history, gold has often benefited during periods of conflict, economic instability, and financial stress. As global power dynamics shift and nations seek alternatives to traditional reserve assets, gold's strategic importance may continue growing. This trend could provide a powerful tailwind for prices over the long term. At the same time, investors should avoid becoming emotionally attached to any single forecast. Markets are inherently unpredictable. No analyst, no matter how experienced, can guarantee future outcomes. The best approach is to focus on probabilities rather than certainties. A disciplined investor understands that multiple scenarios are possible and manages risk accordingly. One of the biggest advantages successful investors have is patience. Instead of chasing every rally or panicking during every decline, they recognize that volatility is a normal part of investing. They understand that corrections create opportunities. If gold does experience a major pullback before eventually moving toward $5,000, investors who remain patient and disciplined may find themselves in a stronger position than those who react emotionally. So, what is the truth about a potential gold crash before $5,000? The truth is that both outcomes can coexist. Gold may very well experience a significant correction in the months or years ahead. In fact, a sharp decline could be exactly what the market needs before the next major advance begins. But a correction and a long-term bull market are not mutually exclusive. History shows that powerful trends often include painful pullbacks along the way. The key takeaway is simple. Don't confuse short-term volatility with long-term direction. Keep an eye on technical levels, monitor economic conditions, watch central bank policies, and most importantly, maintain a disciplined investment strategy. Whether gold pulls back sharply from current levels or continues climbing immediately, the larger forces driving demand for precious metals remain worthy of attention. As always, remember that no investment is guaranteed. Conduct your own research, manage risk carefully, and avoid making decisions based solely on fear or excitement. The coming years could be some of the most important in gold's history. Whether the next move is a correction, a consolidation, or a breakout toward new highs, one thing is certain: the gold market is entering a period that investors cannot afford to ignore. If you enjoyed this analysis, make sure to subscribe, leave a comment with your gold price target, and let me know whether you believe gold crashes first or heads straight toward $5,000. Thanks for watching, and I'll see you in the next video.